Well, I've been saying for a long time that my vision was, I was thinking there would be about $180,000 this fall.
Hmm.
Now a lot of things have happened since then. Yeah. See, here's the global liquidity. This is again, Michael's chart and this is staggered. So Bitcoin is actually, I think 6 to 8 weeks, backwards here. So, it has to catch up. But, I think that what happens here, Danny, is that we have a lot of tailwinds that may push that forward,
Hmm.
the 180,000. I still think that we can see it this year. We could easily double.
Over the past few days, Bitcoin, BTC, has experienced notable volatility, influenced by a combination of macroeconomic factors, regulatory developments, and market sentiment. As of February 27th, 2025, Bitcoin is trading at approximately $86,594, reflecting a decline of about 2.83% from the previous close. The intraday high reached $89,228, with a low of $82,464. This downturn marks a significant retreat from its January all-time high of $109,350, representing a decrease of over 20%. Some factors influencing this development include President Donald Trump's announcement of new tariffs on imports, leading to concerns about inflation and potential impacts on the broader economy. Bitcoin exchange-traded funds ETFs have also experienced substantial outflows, with $1.1 billion withdrawn in a single day, indicating a shift in institutional sentiment, possibly due to the prevailing economic and regulatory uncertainties. Lastly, the market has seen a proliferation of meme coins and speculative assets, leading to concerns about market froth and potential overvaluation. While these developments have led to speculation that the crypto bull market is over and winter is approaching, renowned analysts believe they are nothing but short-term headwinds that will soon resolve themselves. In a recent interview with What Bitcoin Did, reformed hedge fund manager and Bitcoiner James Lavish discusses an important tailwind he believes will push Bitcoin above its current all-time high and toward $200,000 per coin in 2025. As a macro analyst, much of Lavish's work focuses on global liquidity and the impact on assets, particularly risk assets like Bitcoin. Lavish believes liquidity, and not these short-term headwinds, will be a major driver of Bitcoin's price in 2025 and possibly into early 2026. He provides an in-depth analysis in his interview, largely based on a recent discussion with Cross Border Capital's Michael Howell, a veteran analyst with decades of experience in the financial markets. As we bring you clips from Lavish's interview, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for the support, and enjoy the video.
So Michael Howell and I got together and we talked about liquidity. And Michael Howell is from Cross Border Capital. To me, he is the leading analyst on the leading analyst on global liquidity. The guy knows what he's talking about, and he follows this stuff very closely. He's got proprietary models that are powerful. And so we talked for a little over an hour, and so a lot of what my piece is of that newsletter that you're talking about is kind of going just a little bit deeper than our conversation. We kept it pretty high level for everybody to understand it. So, what we talk about, what we mean when we talk about global liquidity is just, you hear about like M2, the money supply and how that's driving the stock prices and sometimes and of course real estate and so asset prices basically. And so, but where does that come from? Where's that? Is it the Fed printing money? Is it banks lending money? Like, how is this? How is there more liquidity? Is it hedge funds? Using derivatives? Is it cross-border transactions and lending? Like, how does this actually? And the answer is it's all of it. And so you have to look at all of it to try to get a sense of how that money supply is either increasing or decreasing. When we talk about the money supply and the expansion and contraction of it, like first principles, first of all, our central banks have manipulated the money, and they've created an absolute disaster with the amount of manipulation that they're doing with the money supply.
Mm-hmm.
They're either adding it to the market or they're taking it away. And when they do that, you have these booms and busts of economic cycles, which are not really as natural as they should be. So we talk about the money supply. Most people think, oh, is the Fed printing money, or are they taking it out? So are they doing the QE, quantitative easing, where they're printing money and out there they're out there buying bonds and U.S. Treasuries and mortgage-backed securities in the open market? Or are they doing QT, quantitative tightening, where they're selling their own securities from the Fed, from the Fed balance sheet? They're selling them into the open market, and that will take money out of the system. So when you're buying it, you're injecting the system with capital that wasn't there before. They just print it from the Treasury. It's not really printing. What they do is they press a button and it shows up on the Fed's balance sheet. The Fed gives it to a bank. The bank goes out there and buys it. It ends up on the balance sheet of the Fed. And that's kind of how they do it. Recently, what they've been doing is quantitative tightening, because we had lowered all the interest rates down to zero, and we had printed all that money and bought all those bonds. Then when inflation spiked up over 9%, the Fed raised rates and they stopped doing QE and they turned around and started doing QT, which means that they were taking money out of the money supply by selling bonds, the bonds that were on the Fed's balance sheet, into the market and taking that capital back out. But other things that people don't think about that Michael's done a good job analyzing, and this is all his proprietary models, but he also adds in their bond volatility. So these are all the things that go into global liquidity. So bond volatility is important because people will use their treasuries, they'll use their bonds as collateral, right? So they'll put their bonds to somebody, lend them to somebody, and they'll borrow cash for those. And how much cash they get for that, the loan to the underlying value, right? Depends on the volatility of that instrument. Mm-hmm. So if the bond is really volatile, well, they'll lend less money because it's more risky. But if it's not as volatile, they'll lend more money, right? So the loan to value will be much higher if it's less volatile. So the volatility really does matter. And that's just another aspect of that calculation. I don't have the calculation, but he's got some incredible charts about it and how these liquidity cycles move. And what he's found is that they kind of move in 5 to 6 year cycles. And in this latest cycle, it looks like we bottomed out in October of 2022. And now the liquidity is coming back. Like, all the central banks were drawing capital out of the system, and that peaked in October 2022 with not just that, but bond volatility, lending practices were down. It's all that goes into it. And so now it's kind of turned back up. You get more confidence in the economy. The central banks stop tightening rates and they start lowering rates a little bit. The lending picks up and all of that. So, and then it kind of turns back up, and it looks like we're in the upswing. And if you do that 5 to 6 year period, it looks like we're gonna peak in liquidity somewhere around the end of this year to beginning of next year.
One of the most interesting aspects of Howell's analysis of global liquidity is central banks not QE. The term not QE refers to central bank actions that, while not officially labeled as quantitative easing, effectively mirror its liquidity-boosting impacts. These measures may include short-term lending facilities, adjustments in repo operations, or other interventions designed to inject liquidity into financial markets without the formal commitment of a QE program. Howell emphasizes that in a global economy burdened by excessive debt, such interventions become indispensable to maintain financial stability. He asserts that large central bank balance sheets are now a necessity, making the distinction between QE and not QE increasingly semantic. Howell argues that the modern financial system's vast debt levels necessitate ongoing central bank support. He points out that a significant portion of financial market activities revolves around refinancing existing debts rather than facilitating new investments. This reality implies that any reduction in central bank balance sheets, as proposed under quantitative tightening, QT, could destabilize markets. Consequently, Howell suggests that central banks will likely continue and even expand their liquidity provisions, effectively perpetuating QE under different guises. The persistence of QE-like policies, according to Howell, has profound implications for investors. Continuous liquidity injections tend to inflate asset prices, greatly benefiting risk assets like Bitcoin and other cryptocurrencies. Here are more clips from the interview.
Yeah, risk assets definitely benefit the most from liquidity, and so you're looking at primarily the biggest beneficiaries are the high flying tech stocks, the S&P, and then of course Bitcoin has been an incredible gauge for global liquidity if you look back in time. The only thing is Bitcoin, it trails liquidity, so if liquidity is up, then it takes Bitcoin somewhere between 2 and 3 months to catch up. So if you overlay those charts though, the Bitcoin chart and the global liquidity chart, man, they look really close. And so that's what you're kind of watching, but it's a 3-month lag. So
Okay.
Right, so it's not a great indicator, but it absolutely is directly correlated today. This may not be forever. I don't think it will be forever, but today it is absolutely directly correlated to the money supply and liquidity.
So do you think as Bitcoiners, instead of paying attention to the 4-year cycle in such a great deal, because that obviously has diminishing effects, do you think liquidity is really the big driver of Bitcoin?
That's a loaded question, but it is absolutely, it absolutely matters. You have to have liquidity for an asset like Bitcoin over the last few cycles to expand and for that price to rise. Will that break eventually? That being so tied to the liquidity cycle, I believe it will. We're not there yet. We're in the middle of it still, but it won't break until there's a reason for people to own Bitcoin other than speculative. And at this point, most people just believe it's speculative. You and I know that that's not the case. You and I have a much longer view on this.
Yep.
And we understand that Bitcoin it's an important allocation to have in your portfolio for multiple reasons. One of them is not just to keep up with the money supply, because money supply drives inflation and Bitcoin goes up with the money supply and saves you from inflation. Now it will matter, but will it be the leading indicator, or will it be the most important thing with Bitcoin? I don't think so. And eventually, it's not there yet though. When it happens, it's when Bitcoin is now taking market share from the rest of the global asset pool. Right. So right now it's been taking market share arguably from gold, and some from equities. Not a lot. I mean, there's $115 trillion of equities in the world, almost 120. And so, there's $120 trillion of cash. There's $330 billion of real estate and $300 billion of bonds. I might have those reversed, but the point is there's $900 trillion. I said billion. Did I say billion? I meant trillion. There's $900 trillion of total assets if you add those all up. 18 trillion of that is gold. So when Bitcoin is taking from gold, but it'll eventually start taking from bonds, is my belief. And that's a little bit down the road, and we can talk about that a little bit later.
So you think then the likely outcome of this is QE happens in like relative short order, quite soon?
I mean, you heard what Bostic just said. They just basically said, we're going to stop QT soon. That's a signal that we need to get ready because we may need to be in the market again at some point here in the near future.
And what kind of form do you think that'll take? Will it be QE like we've seen before?
Well, it depends on what happens in the market. Is it a market shock? Is it something completely unexpected that causes turmoil in the bond market? If it's that, they're going to come out and just print money and buy. They're not going to care. They're going to stabilize the market. They will rationalize that we need to stabilize the market. And so that's what we're doing. But if it's a contained crisis, like they were able to create an acronym for, well, of course they would rather do that and call it.
They'd rather hide it.
I mean, they're doing it right now. It's not technically QE, but they have something called a regular treasury buyback program. So they're out there buying treasuries in the open market from buyers who hold these illiquid treasuries. They're older treasuries. They call them off the run. And these are back in the day, the big bond traders, the banks, they would come into their desk and there'd be a big stack of, it was like you ever see dot matrix printers, Danny? You're too young. But
Yeah, no, I know what they are though, yeah.
Holes on the side and they just, yeah. Well, they had these huge runs of these printouts of bonds, and they had all the bonds in there, all the treasuries, all the mortgage-backed securities. And they would, if somebody called and said, "Hey, what's the price of this bond?" There was no Bloomberg back then, so there was no pricing. Like there was no dynamic pricing for them. It was all on the phone, and there was no ticker for bonds, right? So at least you had stock tickers since way back when, since the buttonwood tree, right? So, but there was nothing to look at, so they had to look at these papers, and so they'd look at the run and say, "Oh, this I'll pay you, 97.5 for this one." Okay. But if they asked for a bond and it was like, well, it's not on the run, I have no idea, it's not liquid enough to even be in this massive stack, then it's called off the run. That means to be really illiquid. Well, now the treasury's out there buying those bonds that are off the run. They're just not liquid. And so why are they doing that? Well, they're creating liquidity in the market, making it easy for people to move their paper, and they're just replacing it by buying those and then issuing new ones. And so it's basically what's happening. Is that QE? Not technically. Does it add liquidity to the market? Absolutely. If you ask Michael Howell, he'd be like, of course it does. It's absolutely what they're doing. Is it a ton? No, but on the margin, it's adding liquidity, just like BTFP did.
In other news, President Donald Trump has announced a significant shift in trade policy by imposing a 25% tariff on the European Union. During a cabinet meeting on Wednesday, he declared, "We have made a decision and will be announcing it very soon," emphasizing that the tariffs will apply broadly, with a specific mention of car imports. Trump criticized the EU harshly, stating, "They've really taken advantage of us. They don't accept our cars. They don't accept essentially our farm products, and we accept everything of them. Let's be honest, the European Union was formed in order to screw the United States. That's the purpose of it, and they've done a good job of it." BlackRock's iShares Bitcoin Trust ETF, IBIT, also experienced record-breaking outflows on Wednesday, shedding $418 million in a single day, according to data from SoSo Value. This figure far exceeds the outflows recorded by competing products. For example, the Fidelity Wise Origin Bitcoin Fund, FBTC, saw $145 million in outflows, while the ARK21 Shares Bitcoin ETF, ARKB, and the Grayscale Bitcoin Mini Trust ETF, BTC, recorded losses of $60.46 million and $55.97 million, respectively. Overall, total outflows reached $754.53 million on Wednesday, and on Tuesday, the cumulative outflows surpassed $1 billion for the first time. These developments and the ensuing market reaction have contributed to what data from CryptoRank suggests is the worst February for Bitcoin in nearly 11 years. The last comparable downturn occurred in 2014 when Bitcoin experienced a 33.7% correction. Yet, analysts like Lavish are certain that recovery is near for Bitcoin and other major cryptocurrencies. For Real Vision CEO Raoul, Solana is primed for significantly higher prices in March. Solana is 2 standard deviations oversold on the log regression channel, Powell notes in a recent social media post. With the lowest RSI since the 2022 lows, the probability is wildly in favor of significantly higher prices in the next month. I have zero cash to add, but this is the sweet spot around here. Do you agree with Lavish and Powell's analysis that the crypto bull market is still ongoing and prices will recover sharply in March? Please leave your thoughts, comments, and observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.